Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a concept that is on commitments and contingencies. We're going to see some of the disclosures and the examples of the same. At the very first end, you can see there is leading up to the quarterly earnings announcement of Wednesday, a bit bad news surfaced for Facebook. Its virtual reality factory, Oculus, which had been embroiled in the lawsuit filed by Maryland-based gaming company, lost the suit and they were ordered to pay $500 million. So, now for the very first and the foremost thing, what exactly is commitments and contingencies? See, a commitment is basically an obligation of a company to external entities that often arises in connection with the legal and contracts executed by the company. See, contingencies, however, are different from commitments. They have a really great amount of difference. It is implied that, obligations that is expected to take place depending upon the outcome of the future event. Here, once you can say that the contingencies are those obligations that may or may not, become liabilities to the company because of the uncertainty of the future event. But as we can see from the above, from the snapshot that we just saw, Facebook's virtual reality division of Oculus has been in a lawsuit due to the allegation of violating the non-disclosure agreement and the copyright infringement and more. So Facebook, in its SEC filing, has included the lawsuit under the contingencies and liabilities section, contingencies liability section. So in this tutorial we'll discuss the nuts and the bolts of commitments and contingencies. First let's start with what exactly is commitments. Let's understand the first and the foremost thing. See, in case of commitment, a commitment is basically an obligation of a company to external entities that often arises in connection with the legal contracts. It arises in case of the legal contracts and executed by the company. So in other words, commitments are the potential, they can be said as potential claims that are been against a company with respect to its future performance under legal contracts. So therefore one can say that commitments are those agreements. Therefore we can say that commitments are those agreements that are expected to take place in the future. However, if the company hasn't made any payment, and therefore one can say that the commitments are those that are expected to take place in future. Nevertheless, the company has to make disclosure of such commitments along with the nature and amount of any unusual terms and condition in the 10K annual reports or SEC filing. So this agreements basically or contracts may include first, short-term and long-term contractual obligations with the supplier for the future purchase. So short and long-term, you can say purchases, short and long-term contractual obligation. Second is known as the CapEx, that is the capital expenditures commitment, contracted but not yet incurred anything as of yet. The third is non-cancelable operating leases is the next. Then we have the fourth is leasing of the property, land, facilities or equipment, land, facility and equipments. The fifth is unused letter of credit, which is known as unused LOC, to reduce debt. So let's understand the commitment through an example. Suppose let's say there is a company which plans to purchase a raw material under a predetermined contract, but as per the agreement, the company will make payments for this raw materials only after these raw materials have been received. Although the company will require cash for this raw material in the future, the event or the transaction hasn't yet occurred at the time of the preparing the balance sheet. Hence, no amount of this recording either in the income statement or the balance sheet. However, the company is expected to make disclosure for such transactions as they are supposed to occur in the future and will impact its cash position. Therefore, the company provides an extensive explanation regarding these commitments in the notes to the financial statement. Now, the next thing that we are going to study is that, what do commitments tell you? We'll take over here the example of AK Steel. Okay. So when such commitments are described in the notes to the financial statement, the investors and the creditor will get to know that the company has taken a step, and this step is likely to lead to a liability. So basically you can say that the information concerning the future commitment remains critical for the analysts, lenders, shareholders, investors, because that provides a complete picture of the company's current and future liability. Now let's take a real life example of a firm and find out that what are its current and future commitments and how they are presented in the financial statement. Like for an example over here, we are going to take an example of AK Steel, which is basically an NYSE which known in NYS it is known as AKS, has entered into various contracts that obligate the company to make legally enforceable payments. So these agreements include like borrowing money. It's like borrowing money, leasing an equipment, and purchasing goods and services. So AK Steel has given a detailed information regarding these commitments, which is as follow. So as you can see over here, there is a detail regarding the contractual obligation. There is a lease obligation and purchase obligation and payments. So as you have seen in the above snapshot of AK Steel, has given an extensive explanation regarding its future commitments basically, and or obligation in the notes to financial statement. The most important point to observe here is that, despite being the liability commitment are shown on the balance sheet, it is because the commitment needs a special treatment, and therefore they are disclosed in the footnotes of the financial statements. Likewise, AK Steel has given a complete information regarding its operating leases. So operating leases are the commitments to pay the future amount. However, it is not recorded as a liability. Instead, the company records in the financial statement, basically in the 10K annual report, okay, basically in the footnotes. So this disclosure includes items like the length of the lease, expected yearly payments, coupled with the minimum lease payments over the entire term of the lease. So the graph which I'm going to show you, that will illustrate AK Steel's operating lease payments for the lease period. As you can see, the operating lease over here, there are the details that are given for 2017, rental expenses, and the total minimum lease payment, which is 64.9, which is the sum total of all. Another example of the commitment could be a decision of the capital investment that a company has contracted with a third party, but it hasn't been yet incurred. Like for example, AK Steel has a commitment for the future capital investment of $42.5 million that it plans to incur in 2017. Although AK Steel has entered into the agreement, it has not yet recorded the amount in the balance sheet in 2016 because it hasn't yet incurred in the investment. So still, it has given a note in the financial statement that I'll show you in the snapshot. See, it's written over here in the snapshot of the commitment. We purchase a substantial portion of the principal raw materials required for our steel manufacturing. The commitments for the future capital investments has been total to $42.5 and all which we expect to incur in 2017. Now let's discuss, what do commitments tell you? We'll take over here the example of Facebook. See, Facebook has as a primary two type of commitment. The first we'll discuss over here. The first one is leases. So basically, Facebook has entered into various non-cancelable operating leases, NCOL, that is non-cancelable operating lease agreements for the offices, data centers and facilities. So operating lease expenses for 2017 is close enough to $277 million. Let me show you that in an article. Over here, there's the details of operating leases, 2017 data, 18-19. As you can see, the 2017 data is $277 million. And the second over here that we are going to discuss is the details regarding, the first was NCOL and the other is other contractual commitment. So that is the case. See, Facebook has already entered into the non-cancelable contract pay commitment of $1.24 billion, $1.24 billion related to the network infrastructure and data center operations. So these commitments are due within 5 years. So as an analyst, it is very important to make note of this commitment as they affect the cash of the company. So what are contingencies? That is the next thing. See, contingencies are basically, you can say they are different from the commitments. It is implied obligation, what that is expected to take place depending on the outcome of the future event. So hence one can say that the contingencies are those obligations that may or may not become liabilities to the company because of the uncertainty of the future event. Okay, so that is the case. Let's understand the contingencies by an example. Assuming that a company is sued for a former employee for around, let's say, $1,000. Okay, because the employee feels that he has been terminated wrongly. So does it mean that the company has a liability of $100,000? Well, it depends on the outcome of this event. So if the company justifies that the termination of the employee, it may not be a liability to the company. However, if the company fails to justify the termination of the employee, it will have to incur $100,000 in the future because of the employee has won the lawsuits. There is a thing called FASB okay, has recognized a number of examples for the loss of contingencies that are evaluated and reported in the same manner. This loss contingencies are like, the first one is like the risk of the loss. Then we have the threat of the expropriation of the assets. The third is basically, you can say, the actual or the possible assessments. The fourth is pending or the threatened litigation, and the fifth is obligation related to the product warranties and product defects. Now let's learn about the next, that is the reporting contingencies. In this particular scenario, there is a basic three critical treatment that have to be taken care while reporting contingencies, and they are like, the first one is a loss contingency and is not recorded in the balance sheet. If it is not realized due to the improbability, it means that it is, if the likely losses are not more than, it is less than 50%, or the amount is not realizable measured, they are not recorded in the balance sheet. Meanwhile, the gain contingencies are usually reported in the income statement upon realization. The second over here is that if there is a probable contingencies can be defined as more than 50% due to the prior obligation. The third is if a probable loss can be determined based on the historical information, then it is considered as reliable measure. Now let's see what are the loss contingencies. See, in case of the loss contingencies, we can understand with the help of an example. The loss contingencies, assuming that a company incurs a contingency at the end of the year one. At that time, the company believes that there is a loss of, let's say, close enough to $300,000 and is probable, but a loss of $390,000, okay, and is reasonably possible. However, nothing has been settled at the end of the year two. So on the time of preparing on the time of preparing of the balance sheet for the year two, the company believes that the loss is close enough to $340,000 and is probable, but a loss of $430,000 is reasonably possible. Finally, at the end of the year three, what happens? The company pays close enough to, in the neighborhood of $270,000 to the third party to settle the problem. Therefore, the company recognizes a gain of how much? It is basically, this is not 27, $270,000. So the final amount that we are going to receive is $70,000. That is the difference. So now let us find out how this gain has been calculated. See, we know that a loss of $3 lakh has been identified, right, by the company at the end of the year one. Now I have taken, let's say, $3 lakh, $300,000, because it is probable amount more than, that is 50%. However, the company expects to recognize an additional probable loss of $40,000 at the end of the year two. In this particular scenario, that is, it is the probable loss that is reported at the end of the two is now basically close enough to $340,000. That is 3 lakh plus $40,000. But at the end of the third year, the company pays only, let's say, $270,000. Then in that scenario, to the third party to settle the problem, then it recognizes a gain over here, that is 3,40,000. This should be 3,40,000 less 2,70,000. Just right over here, that is basically 3,40,000 and 2,70,000. That gives you final amount as 70,000. So this is how the answer 70,000 here was been found. Now let me show you an example of Facebook contingencies example. See, among the other contingencies listed in Facebook's SEC filing, the most important is related to the Oculus VR Inc. versus, in ZeniMax Media Inc. sued Facebook for trade secret misappropriation, copyright infringement, break of contract, tortious inferences with contracts. So ZeniMax was seeking actual damages of up to close enough to in the neighborhood of $2.0 billion, punitive damages up to $4.0 billion. So on Feb 1, 2017, when the verdict was announced, Facebook was asked to pay $500 million in aggregate. Let me show you the article. So as you can see over here, it is written in the article, the plaintiff was seeking actual damages of $2 billion, punitive damages of $4 billion, and equitable relief including the injunction. And there was a defendant on the amount of the damages was awarded by the jury was $500 million in the aggregate. and we believe to have multiple grounds to appeal this result and intend to vigorously pursue the appeals. So, after discussing all the things, we can finally make a conclusions on commitments and contingencies. Is that the first and the foremost thing, you can say organization in the day-to-day life enters into contracts in order to run their business in the best possible manner. Thus, these contracts, you can say, are considered as a very future obligation, which do not necessarily qualify as a liability. But the organization have to describe these contracts in the notes of financial statements for nothing but more than the accounting purpose. So whereas the contingencies are considered as potential liabilities that might occur due to the past events, however, the likelihood of the loss or actual loss both remains uncertain. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.